AI stocks and AI speculation has been dominating the market, but some analysts are asking whether the rally is running too hot. Meanwhile, US small caps have staged something of a comeback. Is it the real deal this time? Let's get more from Martin Roberge, Managing Director, North American Portfolio Strategist at Cananaccord Genuity, who just published some research addressing those very questions. Thanks very much indeed for joining us, Martin. Can we start off with this question of whether AI is in a bubble? You have a couple of charts for us. The first one argues that we're not in a bubble in the sense that tech companies' profits are so huge as a percent of total corporate earnings.
Yeah, that's pretty much in line also with the weight of tech stocks in the index, which is slightly above 30%. And that's a big difference with 2000 if we use that year as a reference guide, when corporate earnings of tech companies were accounted for about 20% of the index, while the market cap was north of almost like 35%. So this time around, we've seen the increase in relative market cap following the increase in the contribution of earnings, of tech earnings in the index. So that's an important differentiating factor with 2000, for example.
Let's get on to your next chart that suggests that AI may be in a bubble. And this one shows that tech companies are spending an awful lot of their profits on pouring it into CapEx, sales, an awful lot of their sales, much higher than, say, in the previous dot-com boom. So that suggests it could be unsustainable, I guess. They can't keep that up forever.
Yeah, exactly. So this is kind of a yellow, if not red flag. But once again, one of the big difference with this CapEx cycle with that of 2000, when it was the fiber optic rollout, is that companies are financing their CapEx with free cash flows. As you may remember, Andrew, back in 2000, it was mostly debt that was financing the fiber optic rollout. So in a sense, it is more sustainable this time around.
What do you think then? Are we, what side do you come down on? That's a simplistic question, but is it unsustainable, this AI boom?
Yeah. If you put a gun to my head, we are in kind of, we're certainly feeling bubble-like vibes out there. But the question is it about to burst? So in our report, we have another chart showing that hyperscalers in the US are now consuming a lot of cash because they are spending on CapEx more than what they generate in cash flow from operations. So the good news is that they have still a lot of cash and what we say balance sheet liquidities, so that they can probably sustain the same CapEx cycle for about another year. But going in 2027, they will need to try to monetize their AI investments because they will just run out of cash, or they may decide to tap debt, but we rarely see that. So to the extent that there's still a 1-year runaway in their CapEx cycle, we would say that we're probably in the 6th, 7th inning of this AI investment cycle. But obviously, as we go in 2027, these companies will need to find a way to monetize their AI investments.
Martin, I've been using AI a bit, just messing around, looking for books to read and getting it to rephrase things. It's amazing. Are you having fun right now looking at it?
Actually, my wife gave me a hard time during a vacation in Italy because, like, I was always like asking GPT like where to have dinner, where to stop, where are the must-see attractions between, let's say, Milan and Firenze. So yeah, it's very useful. But again, like eventually, it doesn't mean that because it is useful. It can be monetized.
Yes.
So companies eventually will need to find a way to get a return on their investment. But for now, again, like we want to be clear, the CapEx cycle is really, really powerful. They still have a lot of money on their balance sheet and cash flow for operations to finance this cycle. But again, we kind of want to make sure that clients understand that there's a time stop, and we think that the wall is probably 2027.
A wall. Okay, let's talk about the small caps. They have underperformed the S&P 500 this year, although by my chart, it looks like the Russell 2000 has been playing catch up. Now, post rate cuts, small caps tend to do well?
Yeah, well, you need a certain number of rate cuts, because what is key, and this is what investors need to understand, small caps do well when GDP growth accelerates, okay, domestically and globally. So you need to provide some fuel, i.e. rate cuts, to get the economy going. As we know, we've been in a world of 2% GDP growth for a little while, allowing the larger caps to do better. But historically, the good news is that once the Fed has lowered interest rates, Fed funds, by about 150 beeps, this is when there's enough in terms of backstop or fuel for small caps to outperform. It is as if the market was saying, you know, we've seen enough monetary reflation to eventually expect the economy to do better. Accordingly, we're willing to move down the market cap chain. And as you know, Andrew, like the market is looking for a September cut and another one in December. So that would be 150 basis points in total. So that would be enough to get small caps going. Number two, everybody is talking about S&P 500 earnings, but few investors are aware that in Q3 alone, earnings estimates of Russell 2000 companies have been revised higher by about 15%. This is a lot. So we know that valuations, cheap valuations, have always been there for small caps. But as we know, valuation is not a timing indicator. But now we have two other catalysts that are putting the conditions in place for small caps outperformance, more rate cuts from the Fed, and positive earnings revisions, and possibly like better GDP growth in 2026.
Martin, thanks. Yeah, it looks like the Russell 2000 in August is up about 7% and the S&P 500 up about 2%. So we have seen a rally there. Thank you very much indeed. Martin Roberge joining us right now, or just joined us, Managing Director, North American Portfolio Strategist at Cananaccord Genuity.